Let's talk about this report from the Nigerian Stock Exchange, which was for the month of January, which shows the interplay of domestic and foreign investors in the local equities space. The report revealed that total transactions declined 13.66% in January to about 232.4 billion naira, or that's about roughly $590 million US, with domestic investors beating foreign investors by nearly 60% in terms of the value of total transactions. Let's ask one of the chartered traders, Nse Chukwu the CEO at Cowry Asset Management, a few questions around this. It's a two-part conversation, so don't be in a hurry, everyone. Just stick around. Johnson, good evening. Sir, it's good to have you here.
Good evening, Bosin. Thank you for having me.
It's good to have you. Let me just warn you very quickly. That's what we're talking about before we got on here. There's a black market globally now for the vaccine, the virus. So be careful out there if anyone is offering you the vaccine on the black market. You said some folks says they have it and they're already paying. That's what's in the news, by the way. So be wary. Make sure of your source. Let's talk about the, what do you make of that, by the way? Let me just ask you.
Well, in the first place, Nigeria has only gotten 3.9 million vaccines, and anybody who is going to get vaccinated in the country that is not coming from the Pfizer, the AstraZeneca, Oxford vaccine, we should know that you're also exposing yourself to a high level of risk. Of course, even the federal government say they are still waiting for NAFDAC certification before they will administer the vaccines. And I want to believe that anybody who wants to get the vaccine must also ensure that you get the vaccine that is certified by NAFDAC, because that's our own Food and Drug Regulatory Agency. And those who are administering those vaccines in US and the UK and other European countries have also gone through their local regulatory agencies to be sure that the vaccine is appropriate for their citizens. So I don't think anybody should go to the black market to get it vaccines. We must wait. A good thing is that the number of infectious cases is coming down in the past couple of days.
Okay, thank you, Les. Now we got your take on the vaccine black market. What did you make of the January 2021 market report released by the Stock Exchange regarding domestic and foreign portfolio investors?
Yeah, Boston, if I tell you I expected it, you'll be surprised, because if you look at the trend in the past 3 years, you will observe that foreign portfolio investment into Nigeria's equity market has been declining. In 2018, it was 51% of the entire vote. So they actually trumped the local investor in 2018. By 2019, they had declined to 49%. So the local investor trumped them. And by 2020, they were only 34%. They accounted for only 34% of activities in the market in 2020. So coming down to about 20% in January was not surprising to me. Of course, we know those factors that are driving away foreign portfolio investment in equities market in the country. So until those factors are addressed, you are likely going to see this trend continue, because there's already a pattern, there's already a clear trend. Like I said, 2018, it was 51% that they accounted for, and they were, by the end of last year, they only accounted for about 33%. 34% or 33.6%, and now down to 20% in January.
Yes, but we've also seen an increase in both local retail and institutional investors. So where do this interplay comes about in terms of equity market investment between local investors who are now taking the front seat, as it were?
Okay, basic thing that happened is that because local interest rates collapsed last year and they remain very low even in January, local investors, particularly institutional investors, are underweighting their portfolios in equities and in fixed income, and overweighting them in equities. So what basically happens is that when interest rates are very low, investors will switch to the instrument that we give them high yield, and this is, in this instance, variable income assets like equities. And that's what happened last year, and it's still happening now. Of course, we are going to see a reversal of that in the past couple of days.
Are we seeing real increase in the number of local stock market participants? I mean, whether they're retail investors, are we seeing increase in real numbers in terms of the number of people who are interested in investing in equities, rather than this interplay of the debt market into the equities market, then depending on the yield or what I kind of call the index return?
Okay, two things. Last year, we saw a reduced vote in equity space in the country. But despite that reduced vote, we saw an increase both in the number of participants, local participants. And basically what happened last year, that the equity market gained 50% last year. And when you have a bull run of that magnitude in any economy, retail investors become excited, become interested, become sensitized. So we saw towards the end of last year, retail investors became interested in what was happening in the equities market and began to come back into the market. But the initial movement was driven by institutional investors like pension fund administrators that had to shift from fixed income instruments to equity instruments. But as the market rallies and people began to lock in profit, it attracts retail investors. So the number of participants actually increased towards the end of last year.
What about the factors that drives the inflows and outflows for foreign investors in the market? Quickly.
The main critical factor that drives foreign portfolio inflow into the economy is the liquid FX, the FX situation of that country, the foreign exchange market situation in the country. One, they are looking for liquidity in the FX market. They want to be able to convert back into their local currency, into their foreign currencies when they want to exit. So if there is no liquidity in the FX market, foreign portfolio investors stay away from the market. As you know, the Nigerian market witnessed, the forex market witnessed lock-in of foreign portfolio investors who sold their portfolio and wanted to exit, but they couldn't access FX to exit. So because those people couldn't exit, new other investors couldn't come in, because you really can't go into a market when you have people trapped. And that's why foreign portfolio investors dried up. If you look at even the capital importation report, only 35 million came in the fourth quarter.
So this particular conversation will start from there when we come back after the break. Johnson Chukwu about these foreign portfolio investors and what they really mean for our market. We'll be right back, everyone. Welcome back to Arise Exchange. Let's just continue that conversation, that line of thought with Johnson Chukwu, the CEO at Cowry Asset Management, who is also a chartered trader. Johnson, thank you very much for sticking by with us. So let's continue that, what you were talking about, this, how we get foreign investors in the market, the role of exchange rate, liquidity, and all of that, as it relates to some of these investors who are interested in the equities marketplace.
Yes, what I was saying is that for foreign portfolio investors, the most attractive factor that would make them come into any market is the state of your foreign exchange market. And if you have the market lacks liquidity, they wouldn't want to come in, because what matters to them is that they want to exit. They want to recover their principal amount of the amount they've invested if they want to leave at any point in time. The other factor that will also influence them is the stability or the predictability of your exchange rate. But the most important factor is liquidity in your exchange in your foreign exchange market. Like I said earlier, the Nigerian market lost liquidity last year, and the foreign portfolio investors who came into the market and sold their instruments couldn't convert back to dollar, and they got trapped. So as they were trapped, other investors that would have come into the market had to stay out to watch until there is enough liquidity for those who are already in to come out. So that's very critical in driving foreign portfolio investment into an economy. If you look at the years or the periods when they were very strong, like 2018, oil price was quite strong. 2019, oil price was strong. In 2018, they brought in about 1.2 trillion. They traded about 1.2 trillion naira of market activities. Accounted about 1.2 trillion naira of the market activity out of about 2.4 trillion naira that was traded that year. And they, like I said, they accounted about 51% of the market activities. But just in the month of January, you saw they only accounted about 20% of market activities. Out of the 232 billion that was traded, they only accounted for just 20% of the market activities, principally because they are not confident that if they bring in their money into this economy, that they can take it out when they so desire.
Okay, let's chat to some corporate news. MTN yesterday announced plans to issue debt instruments days after the telco releases full-year earnings. What's your take on this?
Well, if you look at the result of MTN, you observe that the cost of funding has actually increased. So I want to believe that if most of the funds they assessed were short-term funds, they issued commercial papers in the previous year. So I want to believe that what they want to do now is lock in on long-term debt instruments. Now that rates are still relatively low. Of course, we are seeing upswing in rates in the past couple of weeks, and that might continue. So the appropriate thing for anybody who has a long-term funding needs, like MTN has, is to lock in on long-term debt instruments at this period in time. If you recall, MTN at the earlier stages of their foreign into this country, we are not borrowing locally. We are funding from outside from their parent company. But that changed maybe because of some regulatory pressures, some sanctions that were imposed on them, and obviously their parent company became wary of putting so much resources into the Nigerian market. And now they decided to fund locally instead of accessing cheaper funds from outside the country.
But there are also other commercial paper issuers across the market space right now. Yesterday was still talk about Stanbic IBTC. Today's FMDQ talked about Fitson Pharmaceuticals bringing 10 billion to the market. So it looks like, are you worried, Johnson Chukwu, that there could be what you call investors' fatigue for commercial papers? Or is this still an El Dorado?
No, let me put it this way. It's in the CP market or the short end of the debt market that the equilibrium can be met, can be achieved, where demand and supply can meet themselves. The simple reason is this. Today, we're witnessing appreciation in interest rates, and that means that funders or surplus units will not be in a hurry to lock in on long-term debt instruments. They would rather stay in the short end of the market. And the commercial papers provide that short-term investment opportunities. So for those who are trying to raise money, if you come to the market and want to raise long-term debt now, when rates are going up, nobody wants to lock in his deposits on long-term debt instruments. And the next few days, you realize that the yield on that instrument is far below market yield. So the key thing that's happening now is that issuers or funders are ready to give money. If issuers are ready to come to the market and meet their short-term working capital needs, well as lenders, which are fund providers, are also willing to put their money in short-term debt instruments and wait for market prices to correct further, or yield to correct further, then they can go long-term. So that's why a lot of people are coming to the debt market in the short space, in the short end of the debt market, that is the CP market, because that is the point where those who have funds are ready to put in money for 270 days, and in 270 days, the expected rates would have recovered further and they can go long. Well, as those who want to borrow money, though they desire to borrow long term, but they will not have people who want to give them long term money because nobody wants to get your money locked in for 5 years or 7 years at a time when you can get at best 6%, 7%, when rates could correct to 12, 13%.
Interesting interplay of market forces of demand and supply. Thank you so much, Johnson Chukwu, CEO at Cowry Asset Management. We thank you for your time this evening.